Since 1934, Iowa's farmers have turned to the Iowa Farm Bureau spokesman as their trusted news source. Now, the Spokesman Speaks. Listen in and hear from leading experts on topics important to farmers and agriculture. Now, here's your host.
Welcome to our July 25th edition of the Spokesman Speaks podcast. I'm Andrew Wheeler, and today's episode features recent analysis of the overall farm economy, including rising fertilizer prices. We'll start with Shelby Myers, an economist for the American Farm Bureau, who hopped on a call with us last week to talk about the overall economic picture for farmers. Then, we'll bring you our conversation with Iowa Farm Bureau President Brent Johnson about the incredible increase in fertilizer prices and what's being done to address that. At the very end, after you've had more than your fill of rising input price analysis, we're going to share a new Farm Bureau member benefit that will actually save you some money on your remaining summer travel. Up first, we have Shelby Myers, an economist with the American Farm Bureau. Spokesman reporter Bob Beyond caught up with Shelby last week.
Okay, Shelby, let's talk a little bit about the general farm economic outlook as we head into late summer and early fall. What are your thoughts on the economic factors that seem to be weighing heavily on farmers right now?
Yeah, thank you so much for having me. Hello to all the folks in Iowa. The theme of today is going to be uncertainty. The markets had major reactions earlier this year, particularly over Russia's invasion of Ukraine. And as that conflict has persisted, it's left quite a large hole of uncertainty, not just in grain markets, the prices for farmers that they would receive, but also input prices and the ones that they'll face going forward. Plus, you add in some of these domestic macroeconomic factors like inflation that are the subsequent results of actions taken to help mitigate through COVID-19 precautions and all of that. It's a lot for growers to take on. And in the midst of having to deal with a less than cooperative Mother Nature this year, the economy certainly, I think you can sum it up in one word, is uncertainty.
So we'll touch on a few of those subjects as we go forward. So to get more specific, let's start with the overall current situation with fuel. Where do we sit with costs for diesel and regular fuel?
Well, I think I have got some good news there. We finally have seen a downturn in fuel and diesel prices. And while they're only about 10 to 12 cents lower per gallon compared to last week, this is the second week in a row that we have had this kind of decrease in price. So now we're just hoping and praying that these decreases continue and that we get back down to lower levels. Unfortunately, that uncertainty that we talked about lingers too heavily in the fuel markets to really know for sure. What we do know is that we're still in the middle of peak demand times for fuel. So while the price is going down, we need to gather a little bit more information to analyze what some of the contributing factors to that might be. Are we having drivers drive less, or were their supplies made up somewhere else that are supplementing the increased demand that we typically see this time of year?
How about propane and natural gas costs, especially as growers begin thinking about their drying costs at harvest time? What's the trend line show? I actually read something this morning about preparing for liquid propane shortages this fall. The foreign export market for propane has exploded, leading to a possible supply issue. Can you address that?
Maybe a little bit. So growers should definitely start planning for fall costs. I think we've been talking about that throughout the summer, and propane and fuel are no different. Propane inventories have started to recover from their low levels experienced in March. But when I say recover, they're following a little bit of seasonality and still running behind that 5-year average. In May of 2022, this year, propane stocks were about 6% lower than the 5-year average. So we're not only trying to make up for seasonality lower inventories that we typically see throughout the spring and summer, but we're also trying to make up for the fact that we're behind year-to-year inventories as well. Something that you'll hear me say a lot today, too, is that we've got supply trying to catch up with increased demand, and propane's a great example of that this year. The recovery that we've kind of seen throughout the last couple of months is going to help shift propane prices lower since demand is low right now and the inventories are replenishing. But what we'll see is that if lower prices persist through these summer months, that's an opportunity for growers to lock in prices. But the market has so much uncertainty because you've got OPEC countries and Russia's invasion of Ukraine that it's hard to say for certain what to do. And I know a lot of growers are trying to plan for how they're going to time their harvest just right in anticipation for maybe reduced drying costs or reduced drying in general, so that maybe you don't have to spend that much money on propane. For natural gas, we saw natural gas prices peak for the season back in early June, and they've been on a steady decline throughout the whole month of June. But when July hit, we started to head back on an uptick, and likely in preparation for purchases that would be made throughout the fall and winter. We do have a situation where we're supplying natural gas globally, and a lot of countries are looking to the US for that. So not an unexpected uptick in prices just because of the supply and demand factors. We're still about $2 behind those peak prices that we saw. But again, as global demand ticks up and as we head into some of these colder months, we've got to keep an eye on how prices will react and where we're diverting natural gas to using things like manufacturing goods for fertilizer or exporting so that other demand buyers are stocking up for the fall and winter.
So yeah, you addressed that a little bit. Should growers consider locking in their fuel, propane and natural gas costs now, or wait a little bit?
Yeah, this is something that we've been talking about a lot throughout the summer, that growers definitely need to be thinking about creative ways to reduce or cut costs. And one option to do that is to be working with local retailers to hedge against some of those sudden price increases. If available, have those conversations with your local retailers and see what opportunities are out there to price hedge. I also suggest, utilizing on-farm storage is a great opportunity to explore so that farmers can spread out their costs on inputs and kind of start stocking up. We're seeing that already in a lot of consumable goods, but there's no reason that growers should be any different in their creative ways for input costs.
Okay, so let's switch gears a little bit and talk about input costs, which are high. Many growers have some fertilizer already purchased for fall applications, but for those who don't and are looking to lock in prices for spring, what's the general outlook and trend for fertilizer costs going forward this year and into the next spring? What suggestions would you have for them at this point?
Yeah, fertilizer prices are doing a couple of things right now. Not only are we in a period of low domestic demand, which happens seasonally right now, it's allowing for supply to work to catch up to some of these peak demand times. But we're also seeing commodity prices back off from those summer peaks. You look at corn, it was $8.32 a bushel in the middle of June, but now we're back around $6 per bushel. Soybeans peaked at $17.65 per bushel in early June and are now back around $15. And spring wheat peaked way back in the middle of May at $15.62 per bushel and now sits around $10.76 per bushel. All that to say, DTN also just reported that average retail fertilizer prices continue to be less expensive than the last month during the first week of July of this year, and that trend's been in place for about 6 weeks now. The issue, though, is farmers' ability to store the product if they've been able to lock in some of those lower prices this summer. It's still very limited to those who have on-farm storage facilities who can be flexible and agile to hedge their fertilizer prices like they would be able to with fuel or propane, as we talked about. AFBF requested in our comments on the USDA request for information on access to fertilizer, the RFI for competition supply chain concerns, there's $500 million there. We asked USDA to put money towards providing assistance to farmers to expand on-site farm fertilizer storage capacity so they can help manage costs throughout the year. And unfortunately, or fortunately, depending on which side you're on, USDA kept extending the deadline for the comment period. So more comments come in, more thoughtfulness to the process, sure, but if this request were to be funded and acted upon, it may be too late to implement some of those on-farm, on-site fertilizer storage investments this year in preparation for 2023 inputs. So kind of playing the timing game. I did want to bring some good news to you all, though, that we did just get word that the U.S. International Trade Commission just rejected anti-dumping and countervailing duties on imports of UAN fertilizer tariffs. So that will certainly help with prices moving forward, that we won't have additional burdensome import tariffs on UAN going into this season.
Okay, so let's move on to break evens. Crop prices have been trending downwards. So what does it look like for a grower to be profitable this season and into next season?
Yeah, I think you're going to see growers using a slightly different marketing strategy than they have in the past. Previously, we're trying to manage smaller increases to lower production costs against low commodity prices. This time around, it will be important for farmers to watch global supplies because we're certainly going to supplement a lot on the global market, and then market grain in a way that helps cover not only their immediate rising operating costs, but also rising costs like operating interest too. Everything is just more expensive right now. And so farmers are paying attention to make sure that they can weather this new challenge in a creative way. And we're also going to keep an eye on some of those risk management tools that are available, especially because we're going to be facing some drier weather. And along with the volatile prices, these risk management tools are going to be really important throughout all of this uncertainty.
How are input costs affecting the break-even point?
Yeah, it's interesting. Everybody is talking about margins this year, but I feel like farmers and ranchers have always talked about the margin and folks just never paid attention, or maybe they're waking up to it. And input costs are rising at a much faster rate than commodity prices have risen. And now we're in a situation where commodity prices are backing off from those hot prices. So if input prices don't follow, which frankly they likely won't, economically input prices typically lag commodity prices by about 1.5 to 2 years. So farmers and ranchers will have a harder time breaking even. Their costs could be more than their revenues, and not by any action that they made on their operations or what they did, but just solely because they're price takers in every market that they operate in.
So how about trade? Trade's always a hot topic. How is demand for product on the worldwide market, and what is the actual volume for both crops and livestock?
Yeah, I would say demand for U.S. ag products around the world is good, but a strengthening value of the U.S. dollar will make competing against other agricultural exports more and more challenging as the export year continues. U.S. ag exports hit a record value of about $177 billion in 2021. And thus far, exports in 2022 by value, so January through May, are up about 14% from the same period in 2021. But that's in value. When you look at volume, that's another matter. Export volume for that same period, January through May, are down 7% compared to the same time in 2021. So you do see a little bit of price inflationary factors playing into that. Grains is a great example. We're up by about 18% in value. Commodity prices are up, but we're down about 8% in volume. Beef and pork should probably be talked about separately instead of together in 2022 because they're having very different export years so far. Beef is up 34% by value and up 4% by volume. That's actually really encouraging as a macroeconomic factor and a global economy factor. But pork is down 18% by value and down 20% by volume.
Specific to China, who's our biggest consumer, there's some talk it is backing off on total imports. What are you hearing and how that affects overall trade demand?
Our exports to China in 2021 topped $38 billion. It was a record number. It's about 25% increase from 2020. That being said, the U.S. only had about an 18% market share of the $206 billion Chinese agricultural import market last year. So far in 2022 through May of this year, our exports are up about 19% relative to that same period in 21. So the year is a long way from over, but so far Chinese demand for U.S. agricultural products is holding up in 2022. We certainly are keeping an eye on some updated data throughout the next couple of weeks to see how we're pacing and continuing so far.
Well, let's move to supply chain challenges. Have they lessened? Could you address the supply chain for ag products with ocean shipping and domestic rail and trucking?
Yeah, AFBF was really pleased with the bipartisan work from Congress in getting the Ocean Shipping Reform Act passed and the quick action by President Biden to sign that into law. The bill is going to take key steps to resolve maritime supply chain obstacles that are increasing costs for U.S. agricultural exporters and preventing U.S. shippers from capturing those export opportunities. There are lingering effects of COVID-19 still throughout the global trade that's resulted in a lot of backlog of container ships that are just waiting to be unloaded in some of our most critical ports. Some of that persistent congestion and some of those logistical obstacles really hinder our domestic ability for farmers and ranchers to meet the increases in foreign demand that we just talked about, especially as we're going to be asked to be called upon to supplement some global supplies. So some of these disruptions are present at each step of the supply chain, and they just intensify the frustration that we have, right? We've got railway and ocean ports that play an essential role to be cost effective and reliable in moving goods. But we have service disruptions, we've got delays, we've got heightened costs that continued through at least the second quarter of this year. And while, we're encouraged the Ocean Shipping Reform Act should assist in some of these much needed movements of agricultural goods and some of those other issues that we talked about, there's a lot of smaller changes that can still be applied to help lessen the constraints. And the supply chain really has to continue to be in search of more creative, immediate solutions that can help lessen this. Because again, we've got a lot of consumer demand out there, and the supply chain is constantly trying to play catch up to meet that consumer demand. So either we slow consumer demand and pull off a little bit of the hot market, as you will, or we find ways for supply to rise up and meet that demand.
Well, let's finish with inflation. Inflation is a huge concern. What's the general consensus on whether or not inflation will continue to trend higher, or will it stabilize and fall at some point soon?
We're doing this interview at a peak time because we've got a couple of moving parts to look at. We certainly had last week's inflation rate reported that we surged to about 9.1%. And everybody's keeping an eye on what the Federal Reserve plans to do next week at its July meeting regarding interest rates. There are expectations of maybe a less aggressive rate hike despite the surge in inflation. That could be encouraging news. But what you've seen through evidence in the housing market, for example, and even home builder confidence, is that rising interest rates and lagging supply chains are pulling many of the consumers away from the housing market. And so as more housing data comes in later this week, that'll help speak to consumers' abilities in the marketplace for home ownership. That's certainly a good indicator of how hot the economy is and what we're facing. But I would compare it to similar decisions made on the farm, that interest rates are certainly going to trigger whether investments are made or not made, just like a regular consumer would decide whether to make large investments in assets like home ownership. You also have a new report out today by the Fed that acknowledges that pandemic fiscal support boosted inflation, with higher consumer spending going after the same, or in many cases, decreased production. And so that's led to a lot of what we talked about, demand chasing lower supply, that has led to this. So we've got to find one way or the other to slow that down so that we can reach that equilibrium once again. The good news, I guess, I do like to end with some good news, is that retail sales data and other economic reports are showing signs of hope for the economy, that we can weather this storm and be resilient. But the hardest part about economics is that you are waiting for equilibrium to kind of work itself back out. So we're waiting for supply and demand to find its balance once again.
No shortage of challenges, but we appreciate Shelby coming on the podcast to give us her take on where things stand. Of course, one of the biggest challenges facing farmers, not just now but looking into next year and beyond, is fertilizer prices. It's an issue that's kept Iowa Farm Bureau President Brent Johnson busy over the last few months. Now, President Johnson shares his thoughts with Spokesman editor Tom Block.
Brent, during this past year, farmers have seen fertilizer prices increase like never before. What's been your experience on your farm, and what concerns are you hearing from other farmers?
Yeah, it's a big topic right now. On my farm specifically, the dry fertilizers, the phosphoruses, and the potashes. From 21 to 22, my prices there have doubled, so a 200% increase. My nitrogen fertilizers in the same time period actually tripled. And, there's a lot that goes into that. And there's a lot of increased input costs across the board. But, the conversation around fertilizers, it's highly dependent on the administration's energy policies. And there's also probably some antitrust issues that need to be explored. And maybe we can find some opportunities in there to increase competition in the future.
The doubling and tripling of your fertilizer costs, what impact have those price spikes had on farm profitability and decisions that farmers make, not only this past spring, but maybe going forward?
Ultimately, in 2022, those costs could be absorbed in this year because we have had opportunities to be profitable. Some really good corn and soybean prices to offset some of those input challenges. The problem is going to come forward next year in 2023 and 2024 if our commodity prices erode, which currently today it looks like they certainly are, then that increased cost is not going to be offset as quickly as the commodity prices look at this time. So as of today, new crop prices are about 75% of what old crop prices are. So we've got 75% of our potential revenue already for 2023 as we sit here today. And if we've got these continued increased input prices with less revenue, that certainly is going to challenge and might not even be possible to be profitable unless we have a different circumstance moving forward. And the challenge continues to look that way as we look out further into 24.
And that's something I think I've heard from farmers that, we're in July right now, but farmers are already starting to have to plan ahead, look at next year, and maybe, I don't know if there are concerns about getting supply, in addition to the price, the supply needs, and maybe able to lock in some supplies.
Yeah, and that's one of the really frustrating parts, honestly, is it doesn't seem like production or supply seems to be the big issue. It's pricing, and it's how much the market is willing to bear when it comes to making those products available to producers and at what price.
And as this issue has surfaced here the past few months, have you talked to other groups who have the same concerns?
Well, I certainly have. I've been very busy on this topic, actually, over the last couple months. I've been working closely with the Iowa Corn Growers and the Iowa Soybean Association, two groups specifically that we've had multiple conversations on, trying to find those opportunities to create more competition in the marketplace when it comes to our pricing inputs, and find those opportunities to have our members be profitable in 23 and 24.
Out of those meetings, what are some of the potential solutions or actions that could provide price relief and increase competition in the marketplace?
It's a very complicated situation, and a lot of the fertilizer prices evolve around the energy policies. And so we all know that we're experiencing some really high fuel prices right now. That's totally related to the increased costs when it comes to fertilizer, but there are other things that have also played a part in these costs when we were talking about 200% and 300% price increases. And one of those is currently the tariff situation. That process was actually initiated somewhere around 2019. And the tariffs came into effect here this last year. And so you compound a tariff situation with some world supply issues and geopolitics, it does create a big challenge. But some of those opportunities forward, we have released a letter to the administration asking them to take action on the tariffs. And I'm currently calling on our other Farm Bureau state presidents to get involved in that conversation, and had some really, really good conversations with them. I'm hopeful that we can bring this issue to light and hopefully find a solution moving forward.
Looking out into the future, are there other long-term opportunities that would result in more competition and more stable domestic fertilizer production?
Well, certainly. There are some domestic fertilizer production plants that are trying to come to market, and they're getting caught up in red tape. They're getting caught up in the bureaucracy of the regulatory body of the United States. So, we are asking the administration to look at those opportunities to reduce some of that bureaucracy so those phosphorus and nitrogen plants can come on board. And there's some logistical issues dealing with Canada and the potash situation, so that hopefully we can continue to keep those avenues open and increase the competition in the marketplace and keep that sector of our input costs in check.
This sounds like an issue that's going to require some attention for quite some time. What does the future hold?
Well, what the future holds for us is that this is not a one-time conversation. I am committed, and I'm going to continue this conversation. We're going to continue to explore new opportunities to deal with antitrust issues, specifically in the fertilizer markets, but hopefully finding some more solutions for the fuels and making sure that we've got some production capabilities in the chemistry side of things, so that, moving forward into the future years, farmers across the state of Iowa and the Midwest and the United States have opportunities to get their inputs at a reasonable cost so that they can take care of business and find some profitability opportunities in the future.
Our fertilizer headache isn't going away anytime soon. And as you just heard President Johnson say, neither is Farm Bureau's push for meaningful solutions. Keep your eyes on the Iowa Farm Bureau Spokesman newspaper, and I'm guessing you'll be seeing lots more on our efforts to battle high fertilizer prices in the weeks and months to come. Well, we've reached the end of this episode, and as promised, we're going to leave you with a bit of positive news before you go. You've been hearing a lot lately about runaway prices, so I'm guessing you wouldn't mind hearing about a new way to save on travel. Earlier this month, Iowa Farm Bureau announced a new partnership with Travel Sherlock, a travel booking site that offers savings on hotels, group travel, car rentals, and even more. The partnership allows Farm Bureau members to receive free access to Travel Sherlock's discounts, which are guaranteed to beat public sites like Priceline and Expedia every time. For more on that new Farm Bureau member benefit, check out the link in the notes for this podcast episode or head out to iowafarmbureau.com. That's all for this episode of the Spokesman Speaks podcast. We hope you found it helpful and that you'll join us for our next one on August 8th. Thank you for doing the work that inspires everything we do here at the Iowa Farm Bureau, and thanks for listening to the Spokesman Speaks.
Thank you for listening to The Spokesman Speaks, a podcast by Iowa Farm Bureau. Check out more podcast episodes at iowafarmbureau.com/podcast. You can also find and subscribe to the Spokesman Speaks podcast in the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, and other popular podcast apps. We appreciate your ratings and reviews, and we welcome you to email us your feedback at podcast@ifbf.org.